The actual expense method. This one requires a bit more math but can lead to a bigger deduction. Instead of using a standard rate, you calculate the actual costs of operating your vehicle: gas, insurance, repairs, depreciation, then deduct the percentage that applies to business use. If 40% of your driving is for work, 40% of your car-related expenses could be deductible. Both methods are perfectly legal, but once you choose one for the year, you typically have to stick with it. The standard mileage rate is simpler, but if you drive a lot and have high vehicle expenses, the actual expense method might be more beneficial. A key part of claiming the mileage deduction is keeping detailed records. The IRS isn't going to just take your word for it when you say you drove about 1,000 miles. They expect documentation, dates, locations, and the purpose of each trip. Many people use mileage tracking apps, but if you prefer the old-fashioned way, a simple logbook works just as well, as long as you actually remember to fill it out. One common mistake people make is trying to claim personal trips as business mileage. No, driving to pick up your dry cleaning doesn't count just because you made a quick work call in the car. The IRS isn't easily fooled, and nothing says audit like a suspiciously high mileage deduction with no real business to back it up. You might as well fraud written on your forehead. For those who do use their car for business regularly, this deduction can add up quickly. Whether you're a real estate agent, constantly on the road, a freelancer meeting clients across town, or a small business owner running errands, keeping track of your mileage can result in significant tax savings. It's one of the simplest deductions available. Just make sure you're tracking those miles properly, of course. Next, the 1031 exchange, deferring taxes on real estate gains. For real estate investors, one of the most powerful and completely legal ways to avoid paying immediate taxes on profits is through a 1031 exchange. This provision, named after Section 1031 of the US Tax Code, allows investors to defer capital gains taxes when selling a property, so long as they reinvest the proceeds into a similar property. Essentially, it's a tax-free way to level up in the real estate market. Here's how it works. Let's say you bought an investment property for $200,000, and over time, its value has increased to $500,000. If you were to sell it outright, you typically owe capital gains tax on the $300,000 profit. However, under a 1031 exchange, if you take that $500,000 and reinvest it into another like-kind property, you can defer paying taxes on that gain. It's like hitting pause on the IRS's tax bill while you keep growing your real estate portfolio. Of course, there are rules, because the IRS isn't just going to let you dodge taxes without some fine print, like-kind requirement. The new property must be of the same nature as the old one. The good news? The definition of like-kind is broad, meaning you can exchange an apartment building for a shopping centre or raw land for a rental property. However, your personal residence does not qualify. Strict timelines. After selling your property, you have 45 days to identify a replacement property and 180 days to complete the purchase. Miss those deadlines and the IRS comes knocking for its cut.